Name: Siti Zahra. NPM: 234111110. Kelas:
MNJ 23D.
Comprehensive Introduction to Financial Analysis. Financial analysis is the process of evaluating a company's financial information to understand its performance, financial health, and potential for growth. This analysis is crucial for decision-making and is widely used by managers, investors, creditors, and other stakeholders to make informed choices. At the heart of financial analysis are three primary financial statements. The balance sheet gives a snapshot of a company's financial position at a particular point in time. It highlights assets, which are resources owned by the company, liabilities, which are obligations the company must fulfill, and equity, which represents the value left for shareholders after subtracting liabilities from assets. Financial analysis is the process of evaluating a company's financial information to understand its performance, financial health, and potential for growth. This analysis is crucial for decision-making and is widely used by managers, investors, creditors, and other stakeholders to make informed choices. At the heart of financial analysis are three primary financial statements. The balance sheet gives a snapshot of a company's financial position at a particular point in time. It highlights assets, which are resources owned by the company, liabilities, which are obligations the company must fulfill, and equity, which represents the value left for shareholders after subtracting liabilities from assets. The income statement, also known as the profit and loss statement, details the company's financial performance over a period. It shows revenue, which is the total income from sales, expenses, which are the costs incurred in generating that revenue, and net profit, which is the income left after all expenses are deducted. The cash flow statement tracks the flow of cash in and out of the business. It is divided into three sections: operating activities, which relate to core business operations, investing activities, which involve the purchase or sale of assets, and financing activities, which include borrowing, repaying debt, or issuing equity. In financial analysis, ratios are essential tools that provide deeper insights into a company's operations. Liquidity ratios assess a company's ability to meet short-term obligations. Profitability ratios measure how efficiently a company generates profit from its revenue, with one key ratio being the net profit margin. Solvency ratios focus on a company's long-term stability, such as the debt-to-equity ratio, which shows the balance between debt and equity financing. Activity ratios evaluate how well a company uses its assets, such as the inventory turnover ratio, which indicates how quickly inventory is sold and replaced. The financial analysis process involves several steps, starting with gathering data from the financial statements. The next step is calculating the relevant ratios, followed by comparing these ratios to industry standards or historical data. This helps in identifying trends that can provide insights into the company's financial health. Analyzing these trends is essential for making informed decisions, such as whether to invest, expand, or take on additional risk. For example, let's consider a retail business. If a company has sufficient assets to cover its short-term liabilities, it indicates strong liquidity. A healthy net profit margin would show that the business is able to turn its revenue into profit effectively. If the company has a balanced debt-to-equity ratio, it suggests that the company is not overly reliant on debt for financing its operations, which is a positive sign for long-term sustainability. Financial analysis is not just for large corporations. Finance analysis involves evaluating the financial health and performance of a business, organization, or individual. It includes assessing financial statements, such as the income statement, balance sheet, and cash flow statement, to understand key financial metrics and trends. The goal is to provide insights into profitability, liquidity, solvency, and operational efficiency. There are various types of financial analysis, including 1. Ratio analysis. This involves calculating financial ratios such as the liquidity ratio, profitability ratio, and debt-to-equity ratio to assess the company's performance. 2. Trend analysis. Analyzing historical financial data over a period of time to identify trends and patterns that can forecast future performance. 3. Cash flow analysis. Evaluating the inflow and outflow of cash to determine the business's ability to generate cash and meet its financial obligations. 4. Benchmarking. Comparing financial performance against industry standards or competitors to gauge the relative success of a company. 5. Break-even analysis. Calculating the point at which total revenues equal total costs, helping businesses understand when they will start making a profit. Financial analysis is critical for decision-making by managers, investors, creditors, and other stakeholders to ensure the business is on a stable financial footing and can achieve its strategic objectives.